Welcome back to the channel. So today I have another trading strategy which I'm going to backtest for you over 100 trades. I'll first tell you about the indicator that we're going to be using, show you a few examples, and then perform the 100 trade backtest. This strategy involves only one trading indicator, and it's the famous exponential moving average, also known as EMA. So an EMA is a sort of moving average that gives the most recent data points more weight and relevance. So essentially an EMA reacts more strongly to recent price movements than a simple moving average, also called an SMA, which gives all the observations in the period identical weight. So this backtest is based on the daily time frame with a rolling stop loss, though with a minimum of 1 to 2 risk to reward ratio. So that means that every dollar that we risk, we must be making a minimum of $2. This strategy is offline, which means I'm going to go back in time on the charts to test this strategy and see how it would have performed. So obviously it doesn't take into account commissions or even the spread. So here's the strategy. It's a very simple strategy, but statistically it should work. So let's see how it goes. So we go long when the price closes above the 200 EMA, and we go short when the price closes below the 200 EMA. We place a rolling stop loss at the last swing. We can only have a maximum of 2 open trades at any given time. And every time the open profit increases by 1 R, we move the stop loss by 1 R. When I say 1 R, it's essentially the amount that you risk per trade. So essentially how much you're willing to lose every time you open a trade. So now let's get on the charts so that I can show you a few examples, and then we'll dive into the 100 trade backtest. All right, so here we are on the charts on euro dollar on the daily time frame. So I'll go ahead and add the 200 EMA. So I've got it saved here, moving average exponential. I will change the length to 200, change the method to EMA, and change the color to light gray, add a bit of thickness. So there you go. Essentially, we go long when the price closes above the line, and we go short when it closes below the line. We place the stop loss at the last swings, and then it's a rolling stop loss. So that means that as the open profit increases, we move the stop loss following the profit. So I'll show you a few examples and then we'll dive into the backtest. So here are a few examples. The price closes below the 200 EMA. So we take a short, we place the stop loss at the last swing, and then we move the stop loss to break even as soon as we hit a 1R. And then as soon as we hit a 2R, we move the stop loss to the 1R level, and so on, all the way to this point where we hit the stop loss. The price falls back to the same amount as the amount that we risked, and that gives a 1 to 6.3 risk to reward ratio. We also went long here because the price came back up slightly, crossing the EMA, placing the stop loss at the last swing right here. But that's a loss. So you would have made 1 to 5 actually on this event. And then moving forward, you would have gone long right here, put your stop loss at the last swing. That would have been a loss. However, that short trade right here would have been a 1 to 1 risk to reward ratio. So on those 2 trades, you would have not lost nor won anything. But moving forward, you would have gone long right here with a stop loss perhaps here, and that would have been a loss. However, you would have gone short, probably break even right here. So let's get on the back tests and I'll see you for the results. All right, so here are the results, guys, on the euro dollar. So we had a maximum drawdown of 14%. We were risking 5% of the account per trade with a minimum of 1 to 2 risk to reward ratio. We had 58 wins, 39 losses, and 3 trades that ended up being break even. And we had a maximum of 4 wins in a row and a maximum of 3 losses in a row. So that gives us a win rate of 59% over almost 20 years. So that's a total profit of 1,106.2%. So if you would have started with $10,000, you would have ended up with $110,623. So this strategy is extremely profitable, especially because of the fact that we're using a rolling stop loss with some risk management measures. As you can see on the chart, the red columns are the drawdowns. The drawdown is really low compared to the profit percentage. So this is really a set and forget strategy. So on the daily time frame, it's a long-term strategy, but as you can see, extremely profitable with not that many trades every month or even every year. So that's definitely worth considering and testing even on different time frames. So let me know what you guys think in the comments, and I'll see you in the next video.